Have you ever looked at a stock market crash and just wondered, how does this happen again and again? Well, today we're going to dig into that. We're going to look past all the panic and the crazy headlines to uncover this hidden pattern, a sort of recipe for disaster that seems to repeat itself all throughout history.
So what on earth does a 17th century flower have in common with a modern financial crisis? Honestly, a lot more than you'd think. Back in 1637, people were trading a single tulip bulb for the price of an entire house. It's wild. Now, fast forward to 2008, and it was these super complex mortgage bonds being sold as the safest investment on the planet. Both ended in absolute disaster, and both were fueled by the exact same thing, pure speculative fever.
And that really gets you thinking, right? Is it actually possible that every single major crash, no matter how different they seem on the surface, is basically built from the same core ingredients? Well, as we're about to see, the answer is a pretty clear yes. So, today, we're going to break down that recipe for a financial crash. It turns out there are really just three key ingredients that show up time and time again, right before the whole thing falls apart.
So what are they? Okay, first up, you've got a new thing, some kind of exciting, shiny financial innovation. Then you add in the dead fuel, a massive, and I mean massive amount of borrowed money. And finally, the secret sauce, the human factor. Our own predictable, emotional psychology. Let's break them down.
All right, let's dive into ingredient number one, the new thing. This is almost always some kind of exciting, new, and, let's be honest, poorly understood financial tool or idea.
You know, the experts call this financial innovation. And look, it can be a really powerful force for good, for sure, but it often has this dark side, where it introduces these complex risks into the system that nobody, and I mean nobody, fully understands. At least, not until it's way, way too late.
And this is where it gets really interesting. Just look at the pattern this slide lays out. Before the panic of 1907, you had corporate trusts, these new ways to bundle companies. Before the huge 1929 crash, leveraged investment trusts, which basically use debt to make even bigger bets. In 1987, it was this thing called portfolio insurance, fancy automated computer trading. And of course, in 2008, it was collateralized debt obligations, or CDOs. Every single time, there was a new thing that promised amazing returns with supposedly very little risk.
Okay, on to our second ingredient, which is how all this builds. That new thing gets supercharged by the widespread use of borrowed money, or what we call leverage. This stuff is literally the rocket fuel for financial bubbles.
I mean, just take a look at the Roaring '20s. The market soared an unbelievable 220% in just 7 years. So, how? How does that happen? Well, the entire boom was running on a totally unprecedented amount of borrowed cash. And this right here shows you exactly how. The practice was called buying on the margin. You could put down just 10% of a stock's price and borrow the other 90%. Think about that. People were investing with money they didn't actually have, which magnified their potential gains. Yeah, but it also set them up for absolutely catastrophic losses.
And that brings us to our final, and maybe the most crucial ingredient of all, us. It's the unchanging, totally predictable patterns of our own psychology. Greed, fear, and our incredible capacity for mass delusion.
This cycle, it usually kicks off with this feeling of overconfidence, right at the very top. This was President Herbert Hoover, speaking just 6 months before the biggest crash in American history. That feeling that nothing can possibly go wrong, it's infectious.
And it doesn't take long for the experts to join in, spreading this idea that this time is different. They convince the public, and maybe even themselves, that the old rules of boom and bust just don't apply anymore, that we've somehow entered this new golden age of endless prosperity.
And that feeling of overconfidence, it just trickles down to everybody. In the 1920s, you had shoeshine boys giving out stock tips. In the 2000s, it was this unshakable belief that housing prices could never, ever fall. It becomes this mass delusion where wild, risky speculation starts to feel like a complete sure thing.
And here's the really crucial point, which Warren Buffett explained perfectly. Deep down, a lot of people know the party has to end. But that fear of missing out, that feeling of, I just want one more dance, it keeps everyone on the floor right up until the clock strikes midnight.
So there you have it. You've got a poorly understood innovation, you've supercharged it with debt, and you've mixed in a huge dose of human delusion. At this point, the whole system is incredibly fragile, just waiting for a single push.
what we call a catalyst. And that catalyst, it can be anything, really. The bankruptcy of a bank like Lehman Brothers in 2008 or a failed stock market play back in 1907. It doesn't actually matter what it is. It's just the spark that lights the fuse, and then the whole thing pops with shocking speed.
I mean, just look at Black Monday in 1987. Remember that portfolio insurance we talked about earlier? The computer algorithms, they took over. And as prices fell, they just amplified the panic, selling more and more and more, causing the single largest one-day percentage drop in the history of the stock market.
And that really highlights the biggest difference today, right? The speed. Back in the day, panic spread by newspaper. Now, news and fear can go viral in seconds, while those same kinds of algorithms trade billions of dollars automatically.
But for all that's changed, the one constant, the one thing that hasn't changed in 400 years is us. The underlying drivers are still our own predictable human behaviors: fear, greed, and of course, overconfidence.
So what's the real key takeaway from all of this? I think Warren Buffett puts it best. He describes the economy as a train on a long track. It's resilient, it always gets back on course, but derailments, they're an inevitable part of the journey.
So if we know the recipe, if we know it's innovation, debt, and human psychology, the real question isn't about trying to predict when the next crash will happen. It's about something way more powerful. Asking ourselves, will we be able to recognize the ingredients as they're being mixed next time?